Hello and welcome to the latest video with Money to the Masses. I'm going to be asking Damien lots of questions about different investment terms to help you who, if you currently invest, understand the terms in a bit more detail, or if you are thinking about beginning investing, have a better and clearer understanding of what all of these terms mean. So to get started, Damien, what is a bond?
A bond is an interesting one. So if you think there's a company can raise money a number of ways, and one way is to basically issue debt. So if you imagine you took a loan of your company and you were Tesco's, for example, and Tesco wanted to raise some money, and so they might go out and borrow money, but they doing so like a normal loan. When they borrow money, the person who obviously gives them the money requires a payment, an interest payment. So that is how a loan works, and that's quite straightforward. What makes a bond is that you can sell that loan. That loan can be sold to different people in the secondary market, and that's what a bond is. So the person who owns it at that point is the person who receives the interest payments from Tesco. So it's called a bond. It's effectively a loan to a company or a government, typically. So as an investment, it is normally quite low risk, because depending on the company, if imagine you're lending to the UK government, it's called a gilt, then the chances of the UK government not repaying the loan over time is unlikely. So therefore, the rate of interest you get on it is very low. So you could buy a gilt or a gilt fund, and then you can sell it on, it moves around. So, because these loans can have a 30-year term if they wanted to. So you're not probably going to hold it for all that time. So you might only hold it for a period of time before you sell it to someone else. And of course, depending on what's going on in the market, the price that someone will pay you will vary, because it depends on the amount of the loan left, the income payments coming in, and the credit worthiness of the company. Because imagine if Tesco was about to go bust, you wouldn't want to be anywhere near any loans or debt that they've been issuing. So therefore, the price, if you wanted to sell on a bond from Tesco, for example, would suddenly, your price would be, you'd get for it would plummet if Tesco were running into financial difficulty. But it's a way of investing that is lower risk than if you buy shares in a company, because one of the big things, if you own a share in a company, if a company goes bust, you are very much at the bottom of the pecking order when it comes to getting anything back. And in fact, for most shareholders, you won't get anything back. So that's why there's that sort of risk element and the reward element. Bonds tend to be lower risk depending on who you're lending to, but the rewards you get in terms of regular income is lower. Equities, shares, there's a much higher risk of loss of capital, so you tend to get a bigger share of, obviously, in most instances, it's dividends, income, profit, but it's higher risk and therefore higher reward. So if you hear the word bond, most people don't even really focus on it, but it's effectively a loan that can be traded.